Silver, take a look at its placement. The all-time high, adjusted for inflation, was $1,640 in 1980, so at roughly $40 per ounce, it's a steal. Thus, we are witnessing a global monetary system reset in addition to a typical bull market, from 0.26 to 0.40. Keep in mind that this is mostly a depreciation of currencies and is not going up. You must not, under any circumstances, miss it. Mike Maloney here with a gold update. 106 to 0.41. To start, this chart is showing that gold will still be the most valuable asset in 2025, even though it is a couple of months old. And thus, we shall delve into the subject of supply and demand. However, before we do, allow me to demonstrate how correlation economics reveals that retail buyers of gold and silver are absent. Instead of giving advice, I just tell folks what to do. 106, 124. It's no secret that I've never purchased precious metals. All I do is fill you in on current events and offer some suggestions for topics you might think about. Looking at this, though, you can see that he has performed a mathematical regression which indicates that sales have been falling, 124 to 148. After 2008, it really took off, although retail sales of gold and silver have been on the decline. My goal in creating goldsilver.com, penning the books, and doing everything else was to shield the public from the idiocy of their government. And I think I can say that I have accomplished part of that. From 1:49 to 2 minutes, I have achieved some progress. Now we will demonstrate some of the factors that generate demand. The world's gold market is about to undergo a transformation due to China's new physical gold requirement for insurance companies, 221 to 200. This is also Avery Goodman, and it's just been a few days, a couple of weeks then. There has been exceptional structural demand for physical gold as a result of a new regulation in China that mandates large insurers invest 1% of their assets in the precious metal. Portions, 221 to 251. The United States is cutting back on its treasury holdings. China is de-dollarizing faster and the global gold market is changing, all of which will pay for this move. About 15 to 20% of the world's yearly mine output will be consumed by the mandatory gold purchase at present rates. 15% to 20% of the world's yearly mining supply, which is driving up prices significantly because there isn't much fresh supply, 252 in to 310. In such case, yes. With an increase in price, this percentage will shrink. With mine production remaining flat and institutional demand on the rise, gold prices are poised to soar beyond their present record highs in the years to come. 3 minutes and 35 seconds. In a word, yes. At these costs, it's currently 15 to 20%. But this is almost impossible to meet the demand that insurance firms are obligated to do this. In order to devote 1% of their assets denominated in yuan toward gold, prices must rise. Section 336 to 358. Now let's proceed. According to Bloomberg's Eric Yong, Indian pension funds are considering investing in gold. The pension regulator in India is contemplating loosening investing limitations in response to demands from portfolio managers for innovative strategies to increase returns on a staggeringly large retirement fund. Sections 358 to 425. According to those in the know, they are attempting to convert this currency, which is not yet money, into money. Last month, retirement fund managers sought approval to invest in gold ETFs from senior officials of the Pension Fund Regulatory and Development Authority during a series of meetings. Subjects wished they would only put their money into genuine gold, the anonymous sources added. Time period from 425 to 439. The regulators have sent the funds a draft of the language regarding gold investments and are now reviewing the proposal. This is a major development that could take place. Now let's proceed. 440 to 457. Oh my goodness. In an effort to maintain control of its strategic reserve currency, Eric Jong reports that Indonesia is considering cutting back on gold shipments. This isn't money. It's a reserve fund for long-term planning. Duration, 458 to 522. Again, this is from Bloomberg. They want to keep it inside their borders, but they have a plethora of other fiat currencies as reserves. This is the sole money they have. This is completely legal. The date of this was May 27th, but it was then that Florida legalized the use of gold and silver in commerce. 5.23 to 5.43 metals like gold and silver are thereby being remonetized. So far, no one has done it. For some reason, the Silver Eagle coin costs $1 and the Gold Eagle coin $50. Is this the only way to produce them? On the other hand, are you able to produce them at the go rate? That sounds fantastic. 5.44 to 5.54 Ron DeSanto is making the announcement, so here it is. In Japan, gold recently surpassed 500,000 yen. Gold is skyrocketing and the yen is taking a beating. 609 to 554. There is no developed nation with a worse ratio of debt to GDP than Japan. Either print or collapse is their sole choice. It is true that gold always comes out on top. In fact, its value in Japan has increased threefold since the chart's inception. 409 to 639. Japanese demand for gold has risen in the past 5 years. According to Rick Rule, the world's allocation to gold has fallen to 0.5% in the past few years, from an average of 2% over the past several decades. During the 1980s bubble, I heard and saw estimates that put the value of gold at 8% of all financial assets worldwide. Minutes 640 to 658. If gold's price were to simply return to its mean, demand from investors would increase fourfold. If we were to see a return to the 1980s boom, the demand for investments would be 16 times higher, forcing prices to soar. The signs that it might be beginning are here. From 658 to 711. The Hong Kong Shanghai Bank Corporation reports that in a desperate attempt to secure a safe haven, investors in Hong Kong have tripled their gold holdings. Now let's proceed. Shadow stats. John Williams is a couple of years behind the times in terms of updates. Section 711 to 743. Actually, I had a conversation with John not long ago, and his website went down a few years ago. However, he does email a newsletter to anyone who joins up, so you might want to consider doing that. I just wanted to say thanks again to Nick Laird for letting me use his data collection and how it relates to the CPI. After filling in the last 2 years, I got some shocking figures for gold and silver. Over the years, he has performed an absolutely outstanding job. PTC 815 to 743. If you like what he does, you may subscribe to his channel on his website, goldchartsrus.com. However, here you have it with the other CPI from the shadow government, which, as a reminder, is simply the US government CPI. They have been tinkering with this methodology ever since they introduced it during World War II until 1982, when they transformed the CPI into the CPLI, 816 to 849. I agree that there is a middle ground where the truth lies, but the original CPI is considerably more accurate than the new CPLI, in my opinion. With this in mind, it is clear that gold remains a tremendous value. The alternative CPI corrected for inflation from 1980, according to shadow government statistics, is $35,454 per ounce. My apologies. Between the minutes 8:51 and 9:14, and if you're interested in silver, you should see this. So shiny, have a look at its placement. At roughly $40 per ounce, it's a steal considering the 1980 inflation-adjusted peak of $1,640 per ounce. From 9:14 to 9:25. Oh my. Now we can go on to the next topic. John just sent me these. Our consumer price index looks like this. From 926 to 938. The blue line represents the initial one. This is the CPLI, which broke apart from the original CPI in 1982. The truth, as I mentioned before, is intermediate, from 939 to 1006. Since John was an actuary and his model ceased functioning after 1982, he thinks that gold is simply supporting his assumptions. I spoke with him about this. Something that had worked for decades abruptly stopped, and he couldn't understand why. And the reason he looked into it was because the government agency in charge of calculating CPI, the Bureau of Labor Statistics, began tampering with the formula. The time span from 10 o'clock to 10 o'clock 43 seconds, he goes on to say that the Federal Reserve, Roosevelt's decision to forsake gold, Nixon's closure of the gold window, and the beginning of the changes to CPY reporting all occurred on those crucial dates. Additionally, he releases a graphic that spans a somewhat longer time period, beginning in 1665, when the United States of America was still a concept, not the colonies, but the American colonies anyway. The effects of the Federal Reserve, represented by the green dot, are readily apparent. From 1044 to 1059, there has been a terrible event. Again, going back to the ratio of GLD gold inventory, tons to gold price at its lows. Eric Young. All right then, from 1059 to 1119. What this proves is that I have no faith in GLD. Tonnage is relatively unchanged while prices are rising. This leads the ratio to fall, which indicates that while the price of gold is hitting new highs, the physical gold inventory of GLD is remaining relatively stable at intermediate lows. From 1120 to 1136, who is physically removing gold from GLD? Nick Laird, I am most obliged for the beautiful charts. You may say that goldfish charts represent us, or that gold charts are X. Next up, Trump's red button option, the revaluation of gold. Beginning at 1137 and ending at 1154, Trump is considering a radical gold plan to undermine the Federal Reserve and stabilize the currency. Also, the US Treasury bonds backed by gold are being discussed. The hidden weapon Trump can deploy to challenge the Federal Reserve is discussed in Forbes.